This is Nightly Business Report with Sue Herrera and Bill Griffin.
Calling it quits. Two large mergers are scrapped. What does it mean for the deal-making landscape?
Renter beware. New technology is fueling the rise of rental scams. What you need to know to keep from getting burned.
And disappearing act. You've heard of no-show jobs. Well, how about no-show workers? The growing phenomenon that's caught companies off guard. All that and more tonight on Nightly Business Report for this Thursday, August the 9th.
Good evening, everyone, and welcome. The Nasdaq's streak hits 8. We'll have more on that in just a moment. But we begin with a pair of deals that didn't happen. Well, actually, they did, but then they didn't. First, pharmacy chain Rite Aid and grocer Albertsons called off their planned merger in the face of growing opposition. Several proxy advisors had recommended shareholders vote against the deal. This is the second failed merger for Rite Aid. Last year, its merger with Walgreens was scrapped. Albertsons is privately held, but Rite Aid shares were down 11.5% to $1.54. Bertha Coombs has more.
Rite Aid and Albertsons' breakup came down to money. Large stakeholders in the pharmacy chain felt the $24 billion deal would leave them with too little of the combined firm if the merger were completed. Shareholder advisory firms came to the same conclusion. Albertsons said it was not willing to change the terms of the offer, so the two firms agreed to call off the deal with no breakup fee. Albertsons, owned by private equity firm Cerberus, which has looked to bring the grocery chain public, saw the deal with Rite Aid as a way to leverage its stores for health care. Now, some analysts say investors may not be as interested in an IPO. Rite Aid and Albertsons have both looked to mergers to be able to better compete in the tough retail environment. And as standalone firms, their fates are unclear. Rite Aid's CEO said in the company's announcement, while we believed in the merits of the combination with Albertsons, we have heard our stockholders and are committed to moving forward as a standalone company. But the pharmacy chain now faces a problem of scale at the retail level, having sold off 2,000 stores to Walgreens after regulators blocked the two firms from fully merging last year. And potential regulatory hurdles. Rite Aid's Envision Pharmacy Benefits unit is the most profitable arm of the company, but regulators are looking to crack down on pharmacy benefit rebates, those discounts secured from drug makers through confidential contracts. Analysts say turning things around for Rite Aid after two failed deals is a big challenge, especially as rivals CVS and Express Scripts are looking to merge with insurance partners, making for an even tougher competitive landscape, not to mention the entrance of Amazon into the pharmacy space. For Nightly Business Report, I'm Bertha Coombs in New York.
The other merger to find the scrap heap, Tribune Media calling off its $4 billion deal to buy Sinclair Broadcast Group. Tribune is also now suing Sinclair for breach of contract, saying that Sinclair did not do enough to get that deal approved by regulators. You may remember last month, FCC Chairman Ajit Pai said he had serious concerns about this merger, and he moved to block it. Shares of both companies were higher by nearly 3% today.
So let's turn now to David Nelson for more on the M&A landscape and what he sees ahead for future deal making. He is the chief strategist at Bell Point Asset Management. Good to see you. Welcome.
Thanks for having me.
David, tell me where you think we are. The first half certainly was gangbusters in terms of M&A. Do you expect a repeat of that in the latter part of this year, or have we kind of peaked?
I think we've kind of peaked, and you hit on one of the reasons. There are several reasons why I think we're kind of going to kind of stall out here. One is some shareholders are just saying no. You just talked about Albertsons and Rite Aid. They took the pulse of investors and they decided to walk away from that. You've got activist investors like a Carl Icahn who's dealing with Cigna, and he's saying no to the Express Scripts deal. He's calling it a $60 billion folly. But maybe more important than that is this is a late cycle bull market. And we're probably going to see some of the worst deals right now. This is when CEOs will overpay. And I think investors seem to understand that. And it's happened before. You saw in the past when companies overpay, it's paid for dearly in the later years. Right now, you've got a lot of CEOs who are looking for organic growth, and they're going to try to buy it.
I knew you were going to say that, knowing that you are so price and value conscious and how late we are in this cycle. But
you know me well, Bill.
Are there still areas, sectors that you could see that are in need of some mergers and acquisitions right now that you're keeping an eye on?
You know, company specific, I don't have a name for you right now. There's always deals to be made. And despite what I'm saying and being negative on the second half of this year, in terms of overall volume, I think deals at the right price make a lot of sense. And there are great money managers out there, but there's challenges out there. Hedge funds who are very good at this are saying they're finding it difficult in this space, and they're finding the performance tough to come by. I just read a report from the chief investment officer of Man Group. He's saying deals are very, very tough, and that the performance isn't really following, despite the fact that measures like return on investment are pretty good.
Very quickly, it also seems to me the size of a lot of these deals, they've been enormous. Might we see that scale down a little bit as we go forward?
Well, we're seeing an enormous amount of very small deals, deals that are just greater than $5 billion. Sounds like a small amount of money, and in the world of finance, it is. We're getting 4,700 deals met that size just in this quarter alone. So we're going to see a lot of that. I think the mega deals will be out there. They're tougher to get. What will really be a challenge is cross-border deals. Obviously the political backdrop with countries like China makes it very difficult. They nixed the NXPI deal, and the administration nixed the Broadcom takeover of Qualcomm. So that's a challenge as well.
David, always a pleasure. Thanks so much for joining us tonight.
Thanks for having me.
David Nelson with Bell Point Asset Management. Bill?
Well, as Sue said earlier, you can make it 8 straight days of gains for the NASDAQ. That index has not done that since last October. Amazon hit an all-time high. That helped lift things as well, but energy and financial shares weighed on the broader market today. When all was said and done, the Dow was down 74 points today to 25,509. The NASDAQ was up 3. The S&P dropped by 4 points today.
And speaking of Amazon, that company is reportedly working towards opening primary health care clinics for employees in its Seattle headquarters. CNBC says the plan is to start small for a select group of employees and then expand to more workers next year. In January, Amazon announced a joint venture with Berkshire Hathaway and JP Morgan aimed at improving the quality of care and bringing down healthcare costs.
Mexico's economic minister said today that the U.S. must finish its bilateral NAFTA talks with his country first before bringing Canada back to the table to try and wrap up a new negotiated trade deal. He also said Mexico and the U.S. are working as fast as possible to reach a deal on automotive rules, which have been a stumbling block for this new NAFTA deal.
And Daimler finds itself in the middle of the trade dispute between China and the U.S. The automaker says Mercedes SUVs built at its Alabama plant are being checked by Shanghai Customs for possible problems. China says some models built in the U.S. between May 4th and June 12th have a brake issue, which poses a possible safety risk. Daimler says it is working with authorities to try and resolve any matters.
You know, buying a used car instead of a new one is usually the cheaper option, but get this. The average price of a used car is now at a record $20,000. So what's driving that? Phil LeBeau takes a look for us tonight.
Forget the image of used car dealers peddling old beaters for a couple $1,000s. These days, dealers are selling used models and service plans that few could have imagined just a decade ago. Since 2005, the average used vehicle price has climbed more than $5,000 to hit a record high of just over 20 grand.
There hasn't been resistance. I mean, we are seeing a very healthy amount of sales so far. Largely that does come from off-lease vehicles.
There's been a steady supply of leased 3-year-old models that have been returned to dealers who in turn have sold them at healthy prices since those off-lease models have relatively low mileage and many of the latest bells and whistles buyers are looking for. In addition, dealers are certifying more pre-owned models, selling them with extended warranties and at higher prices.
The gross profit in our pre-owned business improved by 22%. So really strong pre-owned business.
Mix in greater demand for more expensive SUVs and pickup trucks, and you see why dealers are enjoying robust business on their used auto lots.
It's working for us at the moment more is used cars. Our used car sales in the U.S. were up 11% in the quarter, which is a number I've never seen before.
All of this comes as automakers who build and sell new models are increasingly under pressure. Steel and aluminum tariffs could force them to raise prices, while interest rates may force some buyers to reconsider how much they're willing to spend on a new car or truck.
Which could drive many people to the used car lot. It's estimated about 40 million used vehicles will be sold this year, close to a record high. About 2/3 of those will be done through dealerships. The remaining third will be done privately, from one person to another. Phil LeBeau, Nightly Business Report, Chicago.
Time to take a look at some of today's upgrades and downgrades. Morgan Stanley is cutting its outlook on the entire chip sector, saying the semiconductor cycle is showing signs of overheating. As for individual stocks, the firm is downgrading Applied Materials from overweight to equal weight, cutting the firm's cautious view on chip equipment spending. The price target is $54 a share. Shares of Applied Materials were off 2% to $49.16. Citi was one of several firms that downgraded shares of e.l.f. Beauty following the company's weak earnings report. The firm taking e.l.f. down to neutral from buy. e.l.f. cut its full-year guidance, and Citi calls the 2019 outlook bleak, with the analyst saying her confidence in the story has evaporated. That's a quote. The price target was cut from 24 to 16. Shares plunged nearly 34% to $9.85. Bill?
Meanwhile, RBC Capital is cutting 21st Century Fox from outperform to sector perform. The analyst sees upside in the new Fox when assets are then combined with Disney, but limited gains in the remaining company. RBC did raise the price target, though, to 49. Shares rose a fraction to $45.60 today. Raymond James is taking down Mylan from strong buy to outperform after that company's second quarter results missed street estimates, and said that the board will be evaluating a wide range of alternatives to address falling sales. Price target was taken down to $44. Mylan shares fell more than 6% today, closing the day at $36.61.
Now to California, where an 8th person has died in that state's rash of wildfires. A heavy equipment mechanic assigned to the Carr wildfire was killed in a traffic accident. And as those fires set new records, the economic losses also keep piling up. Scott Cohn is in Ukiah, California for us.
It is only August, and more acreage has burned in California than all of last year.
We've seen some significant fires with huge fire growth, with fire behavior that some of us have never seen in our career.
18 major fires burning across the state. The Carr fire near Redding is the most destructive in California history. The Mendocino complex, at 300,000 acres or 475 square miles, is the largest in state history. Some 4,000 personnel are battling this fire alone. The local fairgrounds transformed into a virtual city overnight.
We have sleeping trailers here, to morning briefings, to all of our intelligence that we have, gathering intelligence on the fire, planning for the next shift. All that stuff goes on here. We're completely 100% self-contained.
All of this costs money, and as the fires grow, so do the budgets. California is setting aside more than $2 billion this fiscal year for emergencies, including wildfires. That's money that might otherwise go towards schools or roads. Governor Jerry Brown, who retires in January, calls this the new normal.
We got to re-examine the way we manage our forests, the way we build our houses, where we build them, how we build them, and how much we invest in our fire protection services.
Analysts say for now, state and local governments have the situation in hand with aid from FEMA, but that could change.
I think that, environmental risk is going to continue to evolve, and we're going to have to sort of monitor what the response is and how governments rebuild and reconstruct their tax bases.
As California fights a battle on multiple fronts, growing fires and growing costs. For Nightly Business Report, I'm Scott Cohn, Ukiah, California.
Coming up, working to win the grocery wars.
I'm Courtney Reagan in St. Charles, Illinois, at an Aldi store that's been freshly remodeled. It's all part of the grocer's $5+ billion plan to remodel, refresh, and expand in the U.S. I've got the story coming up a nightly business report.
Now to housing. A newly released Zillow study says that more people are choosing to pay a monthly rent instead of buying a home in 29 of the country's largest cities. This most recent data is available from 2016. Zillow says that nearly 36% of all occupied homes in the U.S. right now are rented. That's up from 31% more than a decade ago.
And with rental demand on the rise and so much of that process done online, it's important for potential renters to be aware of some new scams. Diana Olick has a report on how to spot and avoid them.
Patrick Bauer is a seasoned renter, but even he came close to losing big on a listing because the market is so competitive.
Stakes are pretty high, but so is the pressure to move quickly, and it's just a really tough situation.
Bauer was shopping for apartments online and saw a rental listing on Craigslist that seemed too good to be true, because it was. The person listing it was a scammer who had copied a real listing and changed the contact information. After several seemingly normal emails, Bauer decided to call the supposed landlord.
I tried calling a second time a little while later when I didn't receive a response to the first call, and neither time anybody picked up. And that to me was like the major red flag. And then my wife and I started adding up the various sort of red flags. We said something isn't right here. This price is too good to be true.
A recent survey of renters found 43% had seen listings they believed to be fraudulent. More than 5 million people reported having been scammed. Of those, more than a third of them have lost over $1,000.
There's a lot of urgency, too, in the rental market, especially in some of the really supply-constrained markets that are out there where you have 10 renters fighting for one available apartment. In reality, there's a lot of urgency, and I think scammers can also sometimes prey on this.
The most common scams include the bait and switch, when a different property is advertised than the one that is actually available and the scammer tries to collect a deposit. Then the hijacked ad, like Bauer's. Another scam is listing a property that is already leased and then trying to collect application fees or security deposits. Some scams also happen on legitimate listings. The landlord will advertise amenities that don't actually exist and then try to collect higher rent before the applicant realizes they're missing. The scams are increasing because so much of the process is going online. The best protection: don't rent anything sight unseen, even if you have to send a friend to see it. And don't send money until you're absolutely sure of what you're getting and where your money is going. For Nightly Business Report, I'm Diana Olick in Washington.
The government's investigation into Tesla may be growing, and that's where we begin tonight's market focus. Bloomberg reported today that the SEC was already in the process of analyzing Tesla's statements on manufacturing and sales projections even before CEO Elon Musk tweeted on Tuesday that he was considering taking the company private. The report added that the attorneys are looking into whether Musk's tweet was intended to be taken as a factual statement. And after the bell tonight, sources tell CNBC that the Tesla board is going to meet with financial advisors on Musk's proposal to take the company private. Shares of Tesla were all over the board today, down nearly 5% to $352.45, but they did turn around following the board news. It is smooth sailing for Norwegian Cruise Line. The cruise ship operator raised its earnings outlook for the year after topping Wall Street's expectations with its latest quarterly report. The company cited strong global demand, especially for its new ship, the Norwegian Bliss. Shares rose nearly 4% to $50.95 today. And Booking Holdings, which used to be called Priceline, topped analyst estimates thanks to a rise in guest reservations. But the company, which also owns Open Table, issued a disappointing outlook for the current quarter. It has been known for its conservative forecasts in the past. Still, shares finished down 5% to $1,942.39.
The firearms maker Vista Outdoor reported break-even earnings and weaker sales. The company also lowered its revenue outlook for the year, citing market softness and commodity headwinds, but it did raise its full-year profit forecast. Shares jumped nearly 15% to $18.92. A drop in advertising revenue contributed to weaker profits and sales at Viacom. Still, those results were ahead of expectations. The media company said the success of its motion picture Mission Impossible Fallout has helped financial performance, with Viacom adding that it expects to deliver another profit in the fourth quarter. Shares rose 6% to $30.34. And an activist investor is planning to push Campbell's Soup to sell itself. Dan Loeb's hedge fund, Third Point, disclosed that it had taken a more than 5% stake in the soup maker after what it called, quote, disastrous third quarter results. The hedge fund said it has spoken to the company about the possibility of a sale following what it calls a series of management missteps. Shares of Campbell's Soup rose fractionally to $42.28.
German discount grocer Aldi has its sights now on grabbing market share here in the U.S., and it's expanding to try to make that goal a reality. But of course, the competition is strong and coming from some big names with deep pockets. So is Aldi's approach enough? Courtney Reagan is in St. Charles, Illinois, with a look at how it's going.
Small format grocery chain Aldi has big changes in store, and they're likely coming to a location near you. The Germany-based no-frills budget grocer, whose shelf selection is 90% its own private label goods, is 1 year into its 5-year, $5.3 billion U.S. growth plan, going head-to-head with Walmart and Kroger in a bid to become the third largest U.S. grocer by store count by 2022. It's building 700 more stores over the next 5 years, located near competing grocery stores from coast to coast. The privately held company is refreshing its shelves to include 40% more fresh food and more specialty items like gluten-free and vegan options to appeal to an evolving customer base, and it's paying off.
Our same-store sales over the past several years has been much more than what the industry's realized. And that gives us more confidence to invest in both the new stores, but also to invest in the existing stores in the network to continue to grow our acceptance with the consumers. And it's resonating.
Aldi's organic produce sales have more than tripled in 3 years. Once the product rollout is complete by early next year, about 20% of all items in Aldi stores will be brand new.
Aldi is a important competitor in the grocery war. They're aggressive. They're doing a lot of things that line up to what shoppers want and where the shopper is going.
The grocer cuts costs throughout its supply chain to maximize efficiency and simplicity, so it can offer shoppers a 5-aisle layout with a simple shopping experience for the price-conscious shopper. Shoppers put in a quarter deposit in order to get a cart. Then, once they're done shopping and they're ready to check out, they bag their own groceries with their own bags, or they can buy them. It's all done to keep prices low. Prices are typically between 15 to 40% lower than nearby competitors. A gallon of milk is just 95 cents, and a bottle of award-winning rosé is only $8. Fellow German discount chain Lidl, one of Aldi's largest global competitors, entered the U.S. market with a smaller concept just last year. Kroger and Walmart are rolling out new grocery delivery programs, and Amazon's purchase of Whole Foods last summer sent the thin margin industry into a panic. Aldi is halfway through its aggressive plan to remodel 1,300 older stores. The small grocer says its investments are helping to hold on to current shoppers and bringing in a new crowd, with 7 million new shoppers just last year.
We're appealing at an accelerating rate to more and more customers as they discover the difference at Aldi, which is saving money on great quality products in a convenient, less frustrating shopping environment.
Still, Aldi's big challenge remains getting new customers inside its stores to take a chance on the grocer's own private brands. For Nightly Business Report, I'm Courtney Reagan in St. Charles, Illinois.
Coming up, imagine accepting a job and then not showing up. It's happening more often than you might think. We'll tell you why.
So imagine this, getting a job offer and then not showing up to your first day of work without any explanation. It's a kind of a new phenomenon called ghosting. And as Eric Chemi tells us, the practice is running rampant through many industries.
What started off as a dating term has now spread across Fortune 500 companies and offices across America.
It's called ghosting, and it refers to the practice of ending a personal relationship with someone
by suddenly and without explanation withdrawing from all communication.
It's been happening as we've seen professional organizations, different types of industries. It's happened everywhere.
We decided to investigate. It turns out that job candidates and employees are literally turning into ghosts, disappearing from the interview process.
We've been seeing an uptick recently over the past 6 months in areas related to industries in energy, finance and business services, and industrial and manufacturing.
But it gets even spookier. Corporate managers are telling CNBC that they're seeing ghosts across the entire hiring process. People not showing up for interviews, not showing up for the first day of work. Some people disappearing from jobs they already had.
It's certainly a trend. I mean, with the market as tight as it is for good candidates and so much hiring activity going on, there's definitely more of everything happening, ghosting being one of them.
Experts don't recommend the practice, saying ghosting could come back to haunt you.
It's really important for everybody to remain professional and to get back to people, again, even if it's just brief, but in some form of communication, which there are many of in today's day and age.
For Nightly Business Report, I'm Eric Chemi.
Oh, Eric.
Oh, Eric. That'll do it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a wonderful evening. See you tomorrow.
We'll be here tomorrow. No ghosting.
Yeah.